What happens is that when the interest rates start coming up, the ability of the borrower to meet the obligation to the bank becomes significantly challenged. So as the rates go up, the actual effect that you feel in your portfolio as a bank is that the quality of the portfolio starts going down. Start seeing the non-performing loan portfolio increasing.
Yes.
Non-performing means, it's overdue.
Right.
It's basically defaulted. Now, when that rate is going up, it's not a good sign because it means the recovery of that money becomes extremely doubtful. If you look at, for example, at the end of 2023, the rate had moved from 12.5 in the previous year to 13.3 in the previous year to 14.8 at the end of the year.
Right.
Now, there is a possibility that we might start seeing some improvement in terms of the rate beginning to come down. But we are at a very high level. 14.8 is significantly high.
Right.
There were times when we were in the range of between 4 and 5% in terms of non-performing portfolio, which is a fairly comfortable level for an economy like ours.
Yes.
When you start going into the range of 14.5 and beyond,
there's
you're
worry,
really having a problem because you're talking about now the stability of the financial services sector.
Right.
The banking sector having a huge non-performing portfolio is raising a question on the stability.
Right.
And the stability is a concern for all of us.
Right.
Because the banking sector drives the economy.
Of course.
Yeah.
Of course, Dr. Habil, and as we start to conclude this, very scintillating conversation, unfortunately, time is ticking. In as much as we talk, time is moving. Loan loss provisions, especially from banks, has to now increase. As you know, the Kenya Bankers Association CEO, what exactly are banks saying about this? Well,
fortunately, as I mentioned in the beginning, we have got a fairly well-capitalized banking sector.
Right.
In other words, you have got adequate buffers, and the buffers help cushion us in the event of shocks. Like, for example, the non-performing loan portfolio. When it starts increasing, you have got enough buffers for you to be able to pass the necessary provisions to ensure that all the non-performing portfolio is adequately provisioned.
Right.
So which means that you have taken the losses in anticipation of the loan defaulting. Right. And therefore, when it actually defaults, you're not under threat of the bank going down because of not having enough capital to meet that shock.
Right.
Therefore, the confidence we have now is the fact that we are adequately capitalized. These shocks will come, we'll overcome them, and have a much more stable growth. Right.
What Dr. Habil is essentially saying is that his house is in order, Engineer Chris. When it comes to the manufacturing sector, the banking sector says that they have enough buffers. We're ready to take on whatever challenge that is coming our way. When it comes to the manufacturing sector, as we conclude, of course, what would you say?
I would just want to point out something that I came across. As is rightly pointed out, the non-performing loan portfolio at 15% or thereabout, the details around that also indicates that about 58% of that non-performing loan portfolio is driven by 3 sectors of the economy. 58% of it is driven by trade, manufacturing, and real estate.
Right.
So you notice that our credibility in as manufacturers to access future loans because of the high default rate is now coming into sharp focus.
Right.
And it paints an impression that we really need then to support manufacturing so that it thrives and be able then to service the loans and not be in the bad books of being in the non-performing loan portfolio. Because if you talk about out of the 15.6%, 15%, you take 58 of that percentage. It's really a huge, considering the billions of money that is in question.
Right.
Yes.
And no one wants to be in the bad books of the banking sector, to be honest. No one wants their portfolio to be damaged or soiled in that degree. Of course, we had been talking about, the dollar debacle. There has been a lot of fluctuations in that respect. We were just trying to demystify it, denoise it, see exactly what was happening there and how it was affecting you and your businesses and, of course, the institutions wherein you work. Thank you so much for being a part of this conversation.